Hi, everybody. This is Stephen Rothstein from Ceres. Welcome today. We're going to give people a minute or so to join us. So thanks for joining us, and we'll just be back literally in just a minute to get started. Thanks again for joining us. Welcome to the people joining us. This is Stephen Rothstein from Ceres. We're going to get started in just a few seconds. We're going to just give people another little bit to join us. So thanks for joining, and we'll be starting in just literally less than a minute. Welcome, everybody. My name is Stephen Rothstein. I'm the moderator for today's live stream event. I'm also the managing director of the Sustainable Capital Markets Accelerator at Ceres. Ceres, as many of you know, is a nonprofit working sustainability for over 30 years, working with investors, excuse me, companies and others around the world on a host of global sustainability challenges: water risk, climate deforestation, many other issues. The Ceres Accelerator is focused on initiatives to make our financial markets, the capital markets, more sustainable to address increasing climate risks. We have a significant program working on federal and state regulators, bank regulators, insurance, and other things. This report that we're going to talk about in a few minutes is on the systemic risk posed by the climate crisis to our financial system. I want to start today by just saying, first, our hearts go out to people that are seriously affected by three systemic challenges that we're facing. First, we're all in what we hope is the final phase of the global pandemic, and we are truly grateful for those in the front lines who continue to risk so much and work hard every day. Second is, we want to recognize the pain that's being inflicted throughout our society due to the systemic racism that exists and unfortunately is manifested in so many ways, whether it be in Minnesota or Atlanta or other places, much too frequently. And third, we want to, all of us that are affected by climate crisis. We've seen pictures of the horrific wildfires and hurricane seasons, recently the extreme weather in Texas. We hope today's discussion leads to a real and exciting, robust discussion. Before we begin, a few quick housekeeping things. Note that today's session is being recorded. We'll be providing all the participants with a link to the recording shortly after its completion. If you have questions, please, we welcome them. Please enter them in the chat box that's located on the control panel. We'll do our best to answer all of them if possible. If we don't get to them, if you include your email, we're happy to follow up with you one-on-one. There is always a potential with this technology to have bandwidth issues. And if that's the case, and if it's beyond our control, just stay where you are, and we're going to pause for 20 to 30 seconds, and we'll get back to you. Hopefully that won't happen today. So the goal of today's session is to discuss the newest Ceres Accelerator report called Turning Up the Heat: The Need for Urgent Action by U.S. Financial Regulators in Addressing Climate Risk. And it's part of a broader set of initiatives by the Ceres Accelerator. To talk about that, we have three amazing speakers: Chen, Bob Litterman, and Vina Romani. And I'm going to describe them and give more of their backgrounds in just a minute. But before that, I want to set the context with this short video. This is as I say, the work we're doing is on the federal and the state side. What you're about to hear is 6 brief statements from insurance regulators from across the country, including Nina's boss, who are leading work around the country. So with that, I'm going to ask my colleague to turn that short video on. I'll be back to provide more background in just a minute. Hi, my name is Stephen Rothstein, and I'm the managing director of the Ceres Accelerator for Sustainable Capital Markets. And on behalf of myself and all of my colleagues, we welcome you and want you to hear what insurance regulators from across the nation are saying and what they're doing about the risk of climate change. We value all of their individual and their collective leadership.
Hello, I'm Ricardo Lara, California's Insurance Commissioner. As we recover and rebuild from our devastating wildfires and plan for more extreme heat waves, I am building on California's long history on climate action. We can see all around us that climate change impacts are accelerating and threatening our economy and our people, especially our most vulnerable communities. Financial regulators and the insurance sector have an essential role to putting us back on a path to sustainability and protecting those who are at risk from future climate disasters. That is why I am working with the United Nations on the first state-level sustainable insurance roadmap to urgently reduce emissions and increase resiliency. Together with Ceres and our other climate partners, we can start to repair the damage and reduce the risk to our communities. Thank you.
Hello, I'm Andrew Stolfe, Director for the Oregon Department of Consumer and Business Services. Here in Oregon, we're fortunate to have some of the most diverse landscapes in the nation. Our coastal communities, valley regions, high desert and mountains provide wonderful areas for residents and guests to live, work, and play. This also means we have a responsibility to protect and preserve our diverse landscape for generations to come. We understand the risk climate change poses to our economy and our people. We saw it firsthand with the historic Labor Day wildfires last year. As financial regulators, we take this risk seriously and actively look for ways to take on this ever-present danger in virtually everything we do. Our work has been active and forward-thinking. As a member of Governor Kate Brown's Wildfire Economic Recovery Council, we continue to respond to the worst wildfires in our state's history. We're focusing on equity, fairness, and justice to address the economic recovery of our affected communities. Looking to the future, we're helping lead the work of the National Association of Insurance Commissioners Climate and Resiliency Task Force. This new executive level group is coordinating state insurance commissioners' collective response to climate-related risk and resiliency issues. We're proud to lead an effort to develop climate risk-related disclosures for the insurance sector. Through these and other actions, it's our goal to lead Oregon's financial sector into a more resilient future.
Hello, I'm Mike Kreidler, Insurance Commissioner for Washington State. Here in Washington State, we've experienced increasingly large and devastating wildfires in the past several years. They have become unpredictable and are now our state's #1 climate threat. All regulators, including myself, have a key role in addressing all the risks to climate. That's why I am committed to the Paris Accord to limit climate change, and I'm so pleased that the Biden administration has rejoined that effort. I've joined with other states in requiring large insurers to tell us annually what actions they're taking to respond. Every one of us has a role to play in fighting climate change.
Hello, I'm Linda Lacewell, the Superintendent of the Department of Financial Services here in New York. New York knows climate change. We continually suffer the impact of extreme weather from climate change, including Superstorm Sandy and 100-year storms and floods that seem to happen almost every year all across our state. Climate change poses systemic risks to our economy, our financial system, and our people. As a matter of safety and soundness and risk management, financial regulators must address those risks. That's why DFS was the first regulator in the United States to join the Network for the Greening of the Financial System, NGFS. And we set the expectation that banks and insurers need to integrate consideration of financial risk from climate change into their governance, risk management, and business strategies. We are working together with industry and experts to educate and support our institutions on this journey with purpose, pragmatism, and speed.
I'm Connecticut Insurance Commissioner Andrew Mays. Connecticut is a beautiful state with picturesque shorelines and densely populated coastal areas. Climate change threatens that. So we are one of 6 states leading the effort for insurers to submit their climate risk disclosures through the TCFD. We also joined with neighboring states to pursue systematic pollution reductions and reinvest $300 million each year in cleaner transit, modern infrastructure, and healthier communities, because the world can't wait. Climate change is a systemic risk to U.S. financial markets.
Hello, I'm Mike Pichek, and I'm the Commissioner at the Vermont Department of Financial Regulation. Every year, millions of people come to visit Vermont for its unparalleled beauty, its outdoor recreation, and its unique way of life. That's why myself and my fellow Vermonters have decided to make it our home. In Vermont, we understand that climate change is a risk to our economy. It's a financial systemic risk as well, threatening our banks, our insurance companies, our financial system. That's why in Vermont, we've taken this seriously. We recently released a study looking at the ways in which climate change is impacting our insurance industry in Vermont, making specific recommendations about how, as regulators, or how our industry need to work together to ensure that our citizens and our customers are well protected and that we are all working to combat climate change.
Thank you. It's great to have such leaders across the country in the insurance industry. Let me now talk about leadership, the 3 folks with us today. And I could spend the next hour talking about their bios. I won't. It's like a few sentences about each one. But to be clear, it's not doing their hard work justice. First, Dr. Nina Chen. She's the first ever Director of Sustainability and Climate Initiatives at the New York Department of Financial Services. She is part of the executive team, is charged with developing the department's portfolio of policy initiatives for climate mitigation and green financing. Before that, she'd been at Nature Conservancy as the Director of Conservation, investments in New Jersey. Bob Litterman, who is literally just off testifying in Congress, he finished that about 10 minutes ago, and he'll tell us about that when he talks in a few minutes, is the chairman of risk at Capos Capital. Prior to that, he enjoyed 23 years at Goldman Sachs. He was named a partner in '94 and became head of firm-wide risk function. He's also the co-developer of the Black-Litterman Global Asset Allocation Model. He serves as the chair of the CFTC Climate-Related Market Risk Subcommittee, and we're fortunate that he's on the Ceres board, among many others that he serves. Last, but by no means least, is Vina Romani. Vina is my colleague and the primary author of this report and leads our work in this area. Her work includes governance and financial regulatory work. She's also the author of the last year's report on financial regulations. First, I'm going to turn to Vina to give the highlights of the report that just came out, Turning Up the Heat, and then a moderated discussion both with Nina and Bob. So Vina, I'll turn this over to you.
Thanks very much, Stephen. Vlad, can you move the slide, please? Great. So as Stephen says, I'm going to spend the next few minutes just laying out briefly what we've researched and found in our 2 reports on financial regulation that we've released over the past 10 months. So let me start by just providing some context. We've just seen a video with 6 insurance commissioners talking about climate change being a systemic risk. And this really reflects the fact that our understanding about the risk that climate change poses to companies, investors, and capital markets has evolved. 15 years ago, we were talking about climate change as posing financial impacts. 5 years ago, we understood that some of those financial impacts were so severe, the risk was material. Now, the latest understanding is that the impacts of climate change are so severe that they threaten the very stability of financial markets. And the evidence for this stability risk is all around us. Again, we've heard the commissioners talk about just now, but the physical impacts of the climate crisis are worsening. Last year held the dubious distinction of being the hottest year on record, having the worst wildfire season and the busiest hurricane season. And as Superintendent Lacewell said, these records are being broken annually. We know that frontline communities and communities of color disproportionately shoulder the burden of these impacts. We're also seeing the transition risks of the climate crisis play out in front of our eyes, with growth in regulation and litigation associated with climate change. The impacts, particularly on fossil fuel companies, have really been laid bare this past year, while investments in low carbon options continue to surge. We really are starting to understand how banks and insurance companies sit at the bullseye of these risks that we're just talking about. And while many more of them are starting to set net zero targets, our research also shows that they continue to be significantly at risk from the transition risks of climate change. And none of these impacts happen in isolation. These impacts multiply and magnify each other, and it is this amplification which is the real stability risk. Next slide, please. So where an issue is a systemic risk, it belongs in the mandate of financial regulators. So as Stephen mentioned before, in June 2020, Ceres released a report making the case that climate change was in fact a systemic risk and laying out a call to action for the US financial regulatory community. The report had over 50 recommendations aimed at 8 regulators, but we categorize them in the following way. We call on US financial regulators to affirm the systemic nature of the climate crisis. We call on them to assess the impacts of the climate crisis on financial market stability. We ask them to integrate climate change into prudential supervision, the way that they engage with the industries that they supervise. We call for mandatory climate change disclosure. And finally, we called on US financial regulators to coordinate both with each other as well as the global regulatory community to develop what we saw as the need for a global playbook to deal with what is at the end of the day a global crisis. Next slide, please. I will say the world certainly changed since the release of our report in June of 2020. And the first and major milestone in this evolution came in September of last year, when the Commodity Futures Trading Commission, or the CFTC, issued a climate change report, which 1, affirmed that climate change is a major stability risk, and 2, laid out a sweeping roadmap for what US regulators should do to address this issue. And again, we're so lucky to have with us today Bob Litterman, who spearheaded the development of this report, and he will go into this in some more depth. Next slide, please. While the CFTC was certainly the first out of the gate, we have seen some remarkable forward steps taken by the US regulatory community to address climate change. And this slide captures highlights which have even just happened over the past 3 months. So just over the past 3 months, we've seen the Federal Reserve affirm that climate change is a major stability risk and put in place not just a climate supervision committee, but also a climate stability committee to assess the impacts of the climate crisis from both a microprudential as well as a macroprudential perspective. We've seen our Treasury Secretary, Janet Yellen, call climate change an existential crisis and announce that it would be a priority for the Financial Stability Oversight Council, or the FSOC, going forward. We've seen the acting chair of the SEC, Alison Lee, direct her staff to focus on climate change. She also established a climate and ESG task force in the SEC's Division of Enforcement. And just a couple of weeks ago, we saw her put out a call for information from the public for proposed rulemaking on climate change disclosure. And this is something we'll talk about in more detail towards the end of the webinar. We've seen Ross Benham, the acting chair of the CFTC and the sponsor of the climate change report that I just mentioned, establish a climate risk unit within the CFTC. And finally, as we saw from the insurance video, we've also seen from the New York Department of Financial Services our very first example of proposed supervisory guidance on climate change aimed at insurance companies. And again, we are so lucky to have with us Nina Chen from the DFS to talk to us both about the guidance itself, as well as other things that the DFS might have in the hopper. So the times, they really seem to be changing, which is great. Next slide. But while these are really important steps, it is really important to note that many of these steps are still in the initial stages, and most financial regulators have not even taken them. So 2 weeks ago, Ceres released a report, Turning Up the Heat, which includes the scorecard that you see in front of you, which assessed just the initial steps that US financial regulators have taken on climate change. And as you can see from the scorecard, it's still more red than green, right? So most US financial regulators have still not even taken those initial steps of affirming the climate crisis, starting to do the research, and building the internal competence for them to lean into this issue. And while there are leaders, we certainly saw many of them featured in the insurance video, and we certainly have some of them speaking with us today, they are still the exception rather than the rule. Next slide, please. Ceres believes that the US financial regulatory community can and should do more to address the climate crisis. And our latest report, Turning Up the Heat, outlines what we are looking for regulators to do immediately. These include not only affirming that the climate crisis is a systemic risk, but outlining how this affects their mandate. We've called on regulators to activate action on climate change, including their supervision, as well as issuing rules for climate change disclosure, so everyone can get smarter about the climate-related decisions making that they're making right now. We call on regulators to approach climate change in a holistic and an integrated manner, including considering the impacts of systemic racism on the climate crisis, as well as how pandemic-related stimulus efforts might affect climate change. And finally, we call on regulators to immediately start to build their own internal climate competence, so that regulators have access to the best minds and the best thinking to help our economy navigate these issues in these uncertain times. So Stephen, let me stop there and pass it back to you.
Great, thanks so much, Vina, appreciate that. There are a lot of questions that are already coming in. We'll get to those a little bit later, but let me first go to Nina. Nina, we've talked about DFS. Can you talk about some of the key initiatives that you and your colleagues have been working on recently? Nina?
Yeah, thank you, Stephen. Good afternoon, everyone. First, I want to thank Ceres for inviting me to this panel and for the great report it has produced. As we develop our work to address the financial risks from climate change, Ceres has been an essential collaborator and a resource. Since probably not everyone in the audience is familiar with DFS, I just want to say a few words about who we are. We supervise and regulate the activities of nearly 1,800 insurance companies with assets more than 4.7 trillion and about 1,500 banking and other financial institutions with assets totaling more than 2.6 trillion. So we are the main regulator on the insurance side and co-regulate many banks with several federal agencies such as the Fed and FDIC. I started this position last May and went through the process that Ceres report described of building the internal capacity, communicating to our regulated entities that climate change is a material risk to the financial system, and therefore it's fully within our jurisdiction to focus on it. Like my superintendent, Linda Lacewell, said in the video earlier, we issued formal letters to our insurers and banks last fall, setting the expectations that they need to start integrating the financial risk from climate change into their governance, risk management, and business strategies, and also start developing a disclosure approach. We recommend engaging with the Task Force for Climate-Related Financial Disclosure and other initiatives when doing so. A few weeks ago, we just issued a proposed guidance for New York domestic insurers on managing the financial risk from climate change. It's the first climate-related guidance issued by a US financial regulator. It's informed by DFS' ongoing dialogue with the insurance industry and the international regulators. It's based on the New York Insurance Law, National Association of Insurance Commissioners manuals, and the publications and guidance of international regulators and networks. We held a webinar to provide an overview of this proposed guidance last week and was attended by more than 450 people. The recordings and slides are on our website. This is a topic that really a lot of people are interested and want to learn more. So the overarching message of the guidance is climate change requires a strategic approach, not a reactive one. Insurers need to consider both current and forward-looking risks. They need to assess and manage the risks on both sides of their balance sheet, not just on the liability side, but also on their asset side. We expect each insurer to take a proportionate approach that reflects its exposure to climate risk and the nature, scale, and complexity of its business. Everyone should get started. We also expect the sophistication of the insurer's approach to evolve over time. For example, insurers can start with a qualitative approach in their assessment before moving to a more quantitative one. They can start analyzing how climate change impacts a few risk factors before moving to analyze more risk factors. And over time, they should also consider long-term scenarios and strategies beyond just the 3 to 5 years business planning, but think about what will happen in decades. And DFS will also evolve with the industry. Again, the guidance covers governance, business strategies, risk management, scenario analysis, and public disclosure. I won't go into details, but do encourage everyone to review it and provide comments. Thank you.
Nina, thank you. So I think the next report will be that we're going to recommend cloning Nina 50 times for every state insurance office, and then that will solve the problem. Appreciate all the leadership. And we will put in the chat, the link that Nina referred to, and encourage all of you that are watching and listening to consider responding. Comments are due, Nina, the end of June?
Yeah, it's June 23rd.
June 23rd. Okay, great. And there were a few questions in the Q&A about sharing slides. All of you that are registered will get this, the webinar later, so you can go back and look at the slides later on. Let me go back to Bob, as I say, Bob, your ears were burning because we've talked about CFTC quite a lot already. Can you just talk about the process of setting up the committee, the 34 members, and going through a very complicated system that led to 53 comprehensive recommendations in the process, Bob? I would love to hear your direct thoughts.
Sure. Thanks, Stephen. And thanks to all the panelists, and especially Nina for your terrific leadership on this topic. And I would say with respect to the CFTC, first of all, it was kind of a surprise that it came out of the CFTC. I don't think you would have thought ahead of time that the CFTC would be the leader on climate. And I give credit there to Commissioner Benham, who I think looked at the whole financial regulatory community and said, why aren't we moving forward? And, you know, he said, look, no one else is doing it. I'm going to do it. And he did a great job. He created the committee, you know, in the Market Risk Advisory Committee of the CFTC. They had some hearings, and he got the go-ahead from the commission, which is at that time, you know, this was under the previous administration. So there were 3 Republicans and 2 Democrats, but they moved forward on a bipartisan basis. And they asked for a group of stakeholders in the financial system, which was very broadly, and I would say very carefully constructed. So it wasn't just banks and insurers, although we certainly had those representatives, but it was also corporate America, ranging from you know ag companies, which are certainly part of the CFTC's responsibility, as well as oil companies. We had data companies. We had a lot of academics. We also had many folks from the nonprofit community, and he asked us to write a consensus report, a high-level report. And he suggested maybe 50 pages. Well, you know, we weren't able to keep it to 50 pages. That's the one area where we kind of fell down. But we had a lot of very specific recommendations, almost all of which were directed to the financial regulatory community. But before we get to that, I would say it was very important that recommendation number 1 was that we put a price on carbon. And we also agreed that that is the single most important recommendation. One of the things that made this report, I think, really exceptional was, in fact, that we did gain consensus. At the end of the day, all 34 of those diverse stakeholders voted and represented not only their own personal views, but voted on behalf of their organizations to support the report. And so what that meant is that even though we kind of all agreed ahead of time about where we were going, and we all understood that, we didn't know that we all agreed. And so the publication of the report kind of reveals publicly that there's no disagreement about this. Actually, we all understand it. We all know where we're going, and we have to move forward quickly. And I think that unanimity really allowed for, since the report was published a little over 6 months ago, all of these regulatory agencies to move forward without the concern that they had, 2 or 3 years ago, that this would be controversial. It's not controversial at all. We all know where we're going. We're moving quickly to a net zero economy. And really, what we need now is cooperation between the private sector and the public sector, and leadership from the financial regulators, because this is a difficult problem. If we get into the weeds, what it really is what kind of reporting needs to be done. Now, one of the things we all agreed on early on in the committee was that material climate-related risks have to be reported. That's mandatory. That doesn't require new legislation. The question, though, is what are material risks? And that actually is a little bit more complicated. And that's where we need guidance. We need, really on an industry by industry basis, looking at what's material, because what's material for an oil company is going to be different than what's material for an insurer or a bank or a steel company or a cement company or a tech company. And so we've got to think about that. The other thing I would point out is that you've got to be careful to distinguish between the specific physical risks that are really very location dependent and depend on what type of business you're in, where you're located, what the consequences of climate change are going to be, versus the systemic risk to society, which is really a different type of risk. And whereas the financial regulators can very much oversee the reactions to and how you're dealing with specific risks, insurance is great when you're insuring against the risks to a particular facility or a home or a business, and we should insure those risks. And this is really an opportunity for the insurance business. And they can diversify across, different locations and so on. They can sell the tail risks through a reinsurance market. And these are diversifiable, so they're manageable. What's not manageable is the systemic risk. And we have to be prepared for worst case scenarios. That's one of the things that is fundamental about risk management. It's not the expected outcome that we worry about, it's the worst case. And in the financial markets, we make that very explicit. We talk about the 99.9th percentile of the distribution of potential outcomes, and that's what we have to be prepared for. At Goldman Sachs, we used to go to bed every night and say, would we be solvent tomorrow if all equity markets fell 50% overnight? And that's the kind of stress tests that you really have to look at if you're a financial institution. Now, when it comes to systemic risk, that's something that's further down in the future, and it's what will happen if we don't take aggressive action now to prevent this from getting worse and worse over time. The Scout motto, be prepared, is something that really applies here. We have to be prepared as a society. And that's why that recommendation 1 about pricing is so important.
That's very, very helpful. And your comments on risk, I mean, we're all living on risk, but with the issues of risk, hence this virtual webinar and how we've all lived our lives for the last 14 months. So we've seen a scenario that very few people would have projected 2 or 3 years ago. So those 1/10 of 1% or whatever those are, unfortunately, they do happen. And with climate, as you know so well, Bob, they happen more and more, fires and floods and ice storms and all of that. Just spend a minute, if you can, give the audience more about what you're doing for the Senate Budget Committee today, and what's your thoughts or projections about the potential for a carbon tax?
Yeah, well, thanks for that question. I mean, first of all, I think there are a lot of lessons from the COVID pandemic that apply to climate risk. We live in an interdependent world. Our welfare depends on the actions of others, and we need leadership. Now, what I was doing in the Senate Budget Committee was really quite interesting today. First of all, I was invited by Chairman Sanders, and that was a bit of a surprise. A lot of folks think that the left wing of the Democratic Party has given up on carbon pricing. And obviously, Senator Sanders, you may recall, back in 2016 was a strong advocate for carbon pricing. And, that was before he decided that that might not be the most important priority. Well, I think he understands it. And so what that means is that there may be an opening here. Now, we need Republicans as well if we're going to get bipartisan action. And bipartisan action would certainly be the best approach because it's it'll be more permanent, less likely to be turned back, and we can get stronger action if we can get bipartisan support. I think we're very close, actually, despite the fact that many people gave up years ago. And we could talk about why the politics of carbon pricing are so difficult. But I don't know if we want to go into that as much as just saying where we are today is that I think just like with the CFTC subcommittee, everyone kind of agrees this is a real problem. It has to be addressed. It has to be addressed quickly. You didn't see a lot of pushback. No one on that committee, Republican or Democrat, said, I'm not convinced it's real. No one said, I'm not convinced it's important. Everyone knows it's important. The question is, what do we do? And, every economist understands that the most effective and really the most important thing we can do is create incentives to reduce emissions. That's really what the private sector needs to start moving in the direction we need to go and at the scale that we need to go. And let's not, be Pollyannish about this. We need to move quickly. We need to slam on the brakes quickly about, carbon emissions and start moving in the right direction. So that's what this hearing was all about. And I'm, somewhat optimistic. It's late in the game. We should have done this 30 years ago, but I'm optimistic that we're about ready to move forward. And I'm hopeful that once we create those incentives, we will see the kind of innovation, the kind of movement of capital at the scale that we need toward building the net zero emissions economy that we need over the next 30 years. And one other thing I didn't get a chance to say today, but I'll say it here, is that I think it's going to be very stimulative to the economy. Right now, we have tremendous uncertainty about policy. And so if you're an investor, you don't know what to invest in because you don't know where we're going. Once we say, look, we are going to a net zero economy and we're going to go quickly, then if I'm an asset owner, I know which way we're going to go, and I can start making those investments confident that they're going to be profitable in the economy of the future. So, I'm optimistic that we're going to move quickly, but I will say optimism is not a risk management strategy. We have to absolutely move quickly right now.
That's very helpful. And I'm reminded of the phrase that others have said in climate, if you win slowly, it's like losing. So we have to go quickly in that area. So that's helpful. Let me go back to Nina. Nina, you've talked about great steps that New York has done in terms of hiring staff and doing research. You've written reports, these guidances. What reaction are you getting from other state regulators, and what advice do you have for other financial regulators on how to translate these actions, these initial steps into action?
Yeah, thank you very much for the question. So we have benefited tremendously from others' work. So for example, we during the video that Linda, our superintendent Linda Laceworth talked about, we joined the Network for Greening the Financial System. It's a network of central banks and supervisors working on climate and environmental risk. And we have relied a lot on their guidance, as well as other international regulators, such as Bank of England, the International Association of Insurance Supervisors. While I'm very proud that DFS is a leader in this space in the US, we are really very far behind globally, and not just compared to Europe, but even to China and several other countries in Asia. And the upside is that we have a lot that we can learn from them. Another important thing to point out is that much of our existing risk management framework can and should be applied to manage the financial risk from climate change. Now, our proposed guidance, I mentioned that reference New York insurance law and the risk management manuals that insurers already use. We don't have to completely reinvent the whole apparatus, which should give regulators and the industry comfort to move forward on this quickly. We're also very transparent that DFS is on a journey as we learn about how to supervise the management of the financial risk, just like the industry learning about how to manage this risk. And we'll learn and we will evolve our supervisory actions with the industry and the rest of the world. I think this recognition allows us to put the guidance forward, knowing that it will evolve over time. I think here, perfection could be the enemy of good. I will encourage other financial regulators to also take this iterative approach and take the next steps in action as soon as possible. You asked how the reactions from the industry and other regulators have been. Overall, I would say it has been very positive and similar to what Bob said earlier. Nobody told us that climate change does not create financial risk. The question is more, how do we do this? What resources can I turn to? People also asked us to coordinate with international and federal regulators so we don't create unnecessary regulatory burden. And this we absolutely do. And to support our institutions, we have organized the peer knowledge exchange seminars for our insurers, and Ceres was very kind to participate in that. We had those seminars were attended by more than 1,400 people, and we have given webinars on the fundamentals of climate change and the financial system to our banking institutions. And we have also fielded a lot of calls from other US regulators, both at the federal and the state level. They're very interested in hearing how we did it and what their industry's reactions are. Just as we have benefited from learning from others, we're also very happy to share our experience.
That's great. No, that is very important. And as you said, that iterative process is so important. Vina, let me go back to you. The recent report argues that financial regulators' approach to climate change should be holistic and address the magnitude of systemic risk we're facing in an interconnected manner. Can you elaborate on what Ceres is asking regulators to do?
Yeah, so Stephen, in the beginning of your introduction, you talked about the multiple systemic risks that our country was facing, right? So clearly we're dealing with the climate crisis. We're also dealing with the crisis of systemic racism. We're clearly continuing to deal with the pandemic. And just as climate change affects all these other issues, climate change is also affected by all these other issues. And these are the themes that we try to explore a little bit more in our report. So let's take systemic racism, right? So systemic racism isn't just a social issue, it's a financial issue as well. Decades and decades of systemic racism have led to sort of shocking wealth gaps between, communities of color and white communities. And this has also led to a situation where, low-income communities, which predominantly tend to be communities of color, are both disproportionately exposed to the effects of, especially the physical effects of climate change. They've also historically not been able to access the relief measures associated with, recovery from extreme weather issues. So that's clearly a systemic risk integration point that needs to be addressed as we think about systemic responses to the climate crisis. So one thing that our report calls for is we do call for financial regulators to consider ways to include low-income communities, vulnerable communities, as we think about climate resilience efforts, particularly using, as Nina puts it, structures that already exist. Things like the Community Reinvestment Act provides, we think, a smart framework to build in climate resilience as well as community resilience in a way that's integrated and speaks to each other. Another great example just of the interconnections of systemic risks relates to the pandemic and the climate crisis. So clearly, the Fed and has very, very appropriately pumped trillions and trillions and trillions of dollars into the economy to jumpstart our economy from the sort of soporific effect of the pandemic. But the Fed has provided these funds using a principle of market neutrality, which means that fossil fuel companies have benefited a lot. But as we know, the market is not really neutral. The market is awash with fossil fuel-based assets, which means it's already tilted towards this sector. So again, how can we both ensure that the ways that we rebuilt the economy from the pandemic integrate in climate change considerations are some of the questions that we've asked in the report. And our recommendations really do take a page out of the New York DFS. So what we have done is pointed to approaches taken by other jurisdictions to address these issues, right? Like Canada, for instance, has linked in disclosure of climate change as a part of loans that they are making as a part of their pandemic recovery processes, right? So there's very interesting approaches taken by other jurisdictions that we believe that US financial regulators could consider.
Great. That's very helpful, Vina. Thanks so much. I'm going to turn back to Nina and then to Bob right after. Nina, just following up on Vina's conversation about low and moderate income communities and Community Reinvestment Act. Ceres filed recent comments to the Fed on the Community Reinvestment Act and our thoughts. And if anyone who's watching wants a copy, send us a note afterwards. But you have, I believe, one of the few states that have a state Community Reinvestment Act. Can you just talk about that and what role you think that has in addressing needs of low and moderate income people as it relates to climate issues?
Yeah, definitely. Thank you for that question. And so our superintendent, Linda Lacewell, cares very much about the equity issue and has been talking about the systemic racism and what, as financial regulators, we can do. And we see the New York Community Reinvestment Act as a great vehicle to tackle both. So in February, we issued an industry letter encouraging our banks that are subject to the New York CRA to support the climate resiliency of low and moderate income communities and communities of color. So we highlight examples that already are permitted, referenced in the federal interagency FAQ, such as clean energy, energy efficiency projects, stormwater management to reduce flood risk. So I think for banks that are, need to comply with CRA, we're really trying to encourage them to think harder about how their CRA activities can be used to support both the climate mitigation, reducing the carbon emission, as well as the resilience aspects. Because just like Vina said, these low and moderate income communities and communities of color really tend to suffer more from climate change and have less support in terms of their adaptation.
Great, that's great, and appreciate what New York is doing. Bob, back to you. As financial regulators, I'm thinking more at the federal level, but some at the state, start to go deeper into the details of climate risks. We're seeing a lot of writing emerge about the difficulty of data and modeling. And what do you think about how should they address issues, particularly on scenario analysis and stress tests? And how do we move forward when we have a lot, we know more about climate risk today than other risks, but clearly it's not perfect. What do you think we should do?
Yeah, it's a complex topic, and so there's no simple solutions. You know, the risks that are involved vary by industry, they vary by location. Yes, we have a lot more data, but the question is, how can we aggregate that data and make it decision useful? And you know, what's important to a particular company might not be important to an investor who has a whole portfolio that they're worried about. And so it's really a question of how do we make the data that is hard to analyze? It's hard to aggregate. A lot of it is not public. How do we make it decision useful? And so that's where we have a ways to go on this, no doubt about it. At least we're getting started. That's the good news. And there's a lot of data out there, and more, especially from satellites, that is coming to become available, that is public, and more modeling is being done every day. Now, what's important to make it useful for investors and for regulators and for society as a whole is that it be comparable, and that it be, as I say, decision useful, and that's something, and it be public. You know, a lot of these models are not public, and if you report on data that's not auditable, that's not based on public models, that's not going to be very helpful. So this really falls squarely into the regulators' responsibilities. And when you think about it from a global perspective, it's pretty tough if you're a global bank and you have a regulator in Europe saying one thing and a regulator in the U.S. saying another, and now you're going to have different types of reporting. So we need some standardization here. And that's why organizations like the NGFS are so important, and why it's important to the U.S. participate with international regulators. there's other issues as well. You know, we could go on and on, but for instance, what does it mean to be a green investment or a green bond? Or what does it mean to, you know, claim that you're a sustainable fund? These things are not really well defined. And once again, we need regulators to provide some leadership. We need to define these terms so that investors know what they're getting into.
Absolutely. No, we need more data across the board. And we also, as Nina was saying earlier, I don't think she used these words, we can't let the perfect get in the way of the good, because we have a lot of data and continue. And as we use more data, we'll learn from it. One example of data I'll just share with folks is, and many people who are watching may already be aware of this, but next Monday is a deadline for comments for the Federal Housing Finance Agency. They've submitted a request for input on climate change. I give them credit for their effort to do that. And I know the Ceres is filing comments, and a number of our comments have to do with data. And right now there is great asymmetry in information. If you're a home buyer or even a small developer, knowing the climate impact of that building or buildings, what are the flood risks or hurricane risks. So the more that there is across the board public information, decision useful data, as Bob said, in the mortgage industry, that's just one example. I'm going to shift to a question that's asked by the audience. And again, there's several here, some we've already addressed, and encourage people, if there are more questions, please submit them. So I'll ask this question and anyone's welcome to jump in. The focus so far has been on assessing the risks of climate to the financial sector. But what about the risk of the financial sector to the climate? There's a growing movement among financial institutions to align portfolio to net zero emissions to manage their impact on climate, not just their risks to the bottom line. Can regulators do more to support this process so we can meet the required emissions reduction to avoid catastrophic climate change? I'll throw that over to Bob.
I'll start with that. I think regulators certainly can do more, and I think asset owners in particular have a very important responsibility in terms of the governance. You know, asset owners are the owners of these companies, and so we all know that we're moving rapidly to a net zero economy. The question is, do the companies that we own, are they on board? Are they, you know, is their business model consistent with that rapid change? And how do I know as an owner that it is? You know, it's one thing to tell me that, you know, I agree we're moving to a net zero economy by 2050. Okay, but what are you doing between 2021 and 2025 to make sure that we're on that path? That roadway is not the same as the path that we're on today. We have to change dramatically, and so business models are going to have to change. And I think it's very important that businesses reveal to their owners exactly what they're planning to do.
Absolutely. Any other comments, Vina or Nina?
Yeah, and the only thing I'll add to Bob's comments, Stephen, and I know we're going to talk about disclosure in just a minute, is that this is why we need to ensure that the disclosure that's coming out of the financial industry is not just focused on scope 1 and 2 emissions, it also focuses on scope 3 emissions. So, you know, the emissions associated with their investment and their financing, so that you have a sense not only of their risk exposure, but also of their footprint.
Absolutely. Nina, do you want to add anything before I move on?
Yeah, so I would just comment that, so for us, our mandate right now is the safety and soundness of financial institutions, or the solvency and liquidity for our insurers. I do want to point out that this could be expanded. For example, Bank of England just got its mandate expanded to include fighting climate change. So now it will be within their jurisdiction authority to evaluate their regulated entities, how they're contributing to the low carbon transition. So I mean, that probably was unimaginable just a few years ago. So I do see regulators' role potentially could evolve, but that is driven by the political environment.
Right, right. There's another question here. And by the way, my colleague Vladimir, someone asked about the link for the FHFA. If it's possible to find it and put it in the chat, just to share it with people, or if not, anyone can go to the FHFA website and look under request for input for climate and natural disaster risks. It's out there. So here's another question. Are you worried about comments made by some regulators, such as SEC Commissioner Hester Pierce, or is it just a semantics debate on your view? And I'll kick it off by saying, absolutely, there are different perspectives on this. And the work that that Ceres is doing, that Nina's doing, that Bob at CFTC to move the debate, but we have to continue to talk to people about that. So, but let me open up to any of the questions. Any of the Nina or Vina or Bob to elaborate?
Stephen, I won't comment, I think maybe specifically on what Commissioner Pierce has said, but I will say that we are starting to see narrative emerge, sort of talking about financial regulator focus on climate change is overreach, right? Calling it a special interest issue, calling it an environmental issue, saying, why is the Federal Reserve focusing on this? It should be under the purview of the EPA. I think my response to that, for what it's worth, is that yes, the EPA should focus on it, but that doesn't mean that the Federal Reserve shouldn't also focus on it, right? The reality is that if climate change is a systemic risk, it's got environmental implications, it's got social implications, it's got financial implications, and the financial implications are clear, right? They affect the economy writ large, they affect the banking and the insurance sector, they affect all sectors really. So to be honest, everybody should be playing a role to address climate change. And this is why we think the involvement of regulatory agencies like the Financial Stability Oversight Council is actually so significant, because the role of the FSOC is to really allow for a pan-organizational response, certainly from the financial regulatory community, to climate change, which is why, again, it was for me, the most exciting thing that's happened in this space over the past 10 months, and these 3 months have been almost, it's been breathtaking, the speed with which regulatory developments are happening. For me, bar none, one of the most exciting things that had happened is Secretary Yellen, the Treasury Secretary of the United States, saying climate change is a systemic risk, and this is a priority of the XOF. For me, this is just one of the most consequential things we've seen so far.
Yeah, no, Vina, you're absolutely right. And I watched that FSOC meeting a couple of weeks ago that Chairman Yellen, chaired, and it was amazing how one regulator after the other just said, yes, we agree. Yes, we agree. Yes, we're moving forward. And this is what we're doing. And it's really very gratifying to see that unanimity of understanding and moving forward. And one of the things the CFTC report noted is that we don't need legislation to allow the all of the regulatory agencies to move forward on climate risk. It's part of their mandate, and the heads of the regulatory agencies all sit on the FSOC, and FSOC has responsibility. So I think the U.S. regulatory community is moving forward now, and it's great to see.
It is great to see. There's a lot happening. There are 2 links. Thanks to Nina for putting in the FHFA one, and our colleague has put in our report on Community Reinvestment Act. So if you want to see either of those, I'm going to turn back to Vina. Vina talked a little bit about disclosure in the SEC. There's also a question about greenwashing and how it's important to be accurate. Can you talk about the 90-day period now and what people can do?
Sure, and this is also a link that we can put into the chat. So the context here, and again, we've talked about it. Vlad, let's go to the last slide. I think that's probably the most useful. So the context here is that, financial regulators are focusing on climate change. Companies and investors are setting net zero goals. There's clearly, momentum to try to address climate change in a forward-looking manner, and momentum from companies and investors in particular to chart sort of a resilient path towards the net zero future, which is increasingly being seen as inevitable, right? The choice before us is it planned or is it unplanned? So clearly decisions are being made right now, but in a very real way, many capital market actors are flying blind. To sort of Bob's point, you can't make good decisions without good information. And the state of climate change disclosure is just not where we need to see to give market actors the kind of access to decision useful, reliable, comparable information at scale, for them to do scenario analysis, for them to set smart goals, for them to sort of remake their investment portfolios, keeping these risks in mind. So 3 weeks ago, the acting chair of the SEC, Alison Lee, issued a request for information calling for public capital market actor input on climate change disclosure rules. And this comes within a broader context. This comes within the context of, Apple just 2 days ago became the first public major US company to say climate change disclosure rules are important, outlining that they hope that these rules would include scope 1, scope 2, scope 3 emissions, so great development. And just today, we saw Senator Warren and Congressman Kasten reintroduce their climate risk disclosure bill, whose name I may be getting wrong, but it's a bill that calls on public companies to talk about their climate risk exposure on strategy. So there's clear momentum. I think the call to action that we would like to put out to the webinar participants is to say, reliable, robust, and actionable climate change disclosure at scale is good for everybody. More information is good than less, because all of us are making decisions now that affect the future of not only our markets, but our planet. So the call to action, we would say, is submit comments to the SEC on the kinds of climate change disclosure rules that you're looking to see. And also consider getting involved by efforts being organized by groups like Ceres, where we're in the process of drafting a letter defining principles that we believe that climate change disclosure rules should incorporate. So, it is, I think, going to be important both for institutions to submit their own comments, as well as just broadly become a part of the movement, just calling for climate change disclosure rules to create the kind of clarity that I think the markets desperately need. So if you would like to be kept in the loop on the Ceres letter, do include your information in the link, which is both on the slides, as well as, I hope, through the magic of technology, is making its way to you in the chat. So Stephen,
It is.
back to you.
Yeah, no, thank you very much. We hope everyone's involved. As I said, there's a lot happening, whether it be the Warren Kasten bill, see Bob Litterman testifying today, important work done by DFS, and so many others. We want to work with all of you on this. Thank you for joining today. We look forward to staying in touch and appreciate all of your efforts. And it's special thanks to Nina, Vina, and Bob for all of your leadership. Have a great afternoon. Bye-bye. Thanks so much.
Bye.
Thank you. Bye-bye.
Bye.